The Fed meeting has come and gone, and it's safe to say the decision had an impact on the market. And yet, we're not entirely convinced the currency market got this one right. And we're actually seeing this proven in early Thursday trade. While U.S. equities continued to extend their decline to fresh yearly lows, the U.S. dollar decided to rally back after there had been some selling of the buck into the risk. The reason? It seems the FX market was looking for the Fed chair to come off a little more dovish than he did. It wasn't because of the rate hike itself, as this was already priced in. It was more about what we had highlighted in our special report of the event, which was the fact that looking at the economic data alone, there really wasn't much reason for the Fed to be altering its outlook. But because of other uncertainties and downside risks, the Fed would be forced to adopt a more cautious approach than what had been signaled in 2019. While the Fed chair did make references suggesting this possibility of a pause in 2019, he stopped short of delivering the dovish message the market wanted. But overall, the decision was in line with the expectation of this desk, and we believe it sets the stage for the Fed to make their intention to ease up more clear in early 2019. This would have the dollar selling back off again into this post-Fed run, with the gains to be more pronounced against the major currencies, with risk-correlated FX contending with that fallout in stocks, which is offsetting. Looking at some of the key levels out there today, pay attention to euro dollar 115. A break above that barrier would be significant and could open the start to a much bigger move. Keep an eye on dollar yen 111.35. This is an important short-term level of support, and if broken, could open an acceleration of declines back towards the 2018 low from March, all the way down in the 104s. Looking ahead, key standouts on the calendar come in the form of UK retail sales, the Bank of England policy decision, US initial jobless claims, and the Philly Fed. Earlier today, Kiwi took a hit on soft GDP numbers, but got some help from an offsetting, more positive trade balance, while Aussie welcomed solid employment data. That's all for now.